Welcome to Real Estate 360 Live with Ryan Sloper, the trusted name in real estate radio. Now, here's Ryan Sloper.
Welcome back, everyone, to another episode of Real Estate 360 Live. I'm your host, Ryan Sloper. For those of you not familiar with the podcast, my guest and I will cover all angles of real estate, from interest rates to the economy, to what's happening in Washington, the Federal Reserve, internationally. We'll cover a little bit of everything. We'll jump in today, actually, Treasuries, and there's been a significant drop-off of foreign participation in buying up Treasuries. What does that mean? How does that impact us here in the United States? How does that affect real estate and mortgage interest rates and all the things that come along with the real estate market? We'll also dive a little bit deeper into mortgage interest rates. They've been on the upswing. And we want to kind of dive deeper into why that happened and what the potential implications of that are. We've got, obviously, retail sales number that came in, a Homebuilder sentiment number, so we'll touch on those as well. If you haven't done so already, you can go to iTunes and subscribe to the podcast. Obviously, you can download it, but to subscribe, it'll come directly to your phone when there's a new episode. Just type in the search bar, Real Estate 360 in the iTunes search bar, and you'll be directed right towards a place where you can download, subscribe, and share with your friends. Also, if you don't have access to iTunes, you can obviously stream it via the website at realestate360live.com. On the right-hand side, there's an Ask a Question button for any questions, future topics you'd like us to cover, anything regarding real estate or economics. We'd be glad to cover that. Joining me on our panel, as he does each and every week, is Louis Camerosano. Louis is a former school teacher, former attorney, former general manager of a major real estate portal. He's often cited in the media as a real estate industry expert. In the Inman News, Wall Street Journal, Forbes, Fox Business, U.S. News, MSN, CNN, and numerous others. Louis, how are you doing today?
Doing grand, Ryan. How are you?
I'm doing well, sir.
Excellent.
So, as we left off the last episode, we kind of talked about, you feel really strongly that the Fed will hike rates come September. They will make that token move there where it signifies that, hey, things are moving in the right direction. Even though we know they're not, they'll just make the move to continue the play that they have this market exactly where they want it, and they have full control over everything to signal to the rest of the world that, don't worry about the United States. We're strong here. We have seen a significant uptick in the 10-year note. I believe it closed at around 2.33, somewhere around there, which obviously means there's been an increase. Not always does that signify higher interest rates, but for the most part for the last 2 weeks it has. And rates have been on the rise for the last 2 weeks. And it makes sense, most of what you said, with them going ahead and the market baking in this hike, because when you see the 10-year moving up, you see mortgage interest rates moving up. They've already accomplished and got rates to where they should be if there's a hike of 0.25%. So it does appear that at the moment that you are right that they plan to do that in September to continue this mantra that everything is okay and that, don't worry about the United States. I wanted to first get your take on that. We have the Fed meeting that's coming up tomorrow. They start today and tomorrow with their policy rate decision. Wednesday, I believe it's around 2 p.m. or so. So I want to get your take first on the Federal Reserve and their meeting tomorrow, also with the 10-year note rising and mortgage interest rates going up, what you think the potential implications of that are. And also, you did a blog post on foreign participation, basically the purchasing of Treasury Bonds. And there's been a significant decline, specifically Belgium, that I want you to talk a little bit further and what the implications of that are. So first touch on the Fed, and then the second touch on the Treasury participation.
Okay, so the Fed, Ryan, has been insisting with the media's complicity that there is a recovery, everything is fine, and we are on track for a rate hike because the economy can withstand it, because it's time, we've reached escape velocity, and now it's time to normalize interest rates. Now, as you know, I agree they will raise interest rates, but not because I think the economy is doing fine, but that's the cover story that they're going to use to raise the rates. And, the reason I think they're going to raise the rates is, and it segues into the next point on the decline in foreign purchases of U.S. Treasuries, is the United States needs to counteract the de-dollarization efforts that are going on across the globe, where the dollar is being used less as a transactional currency. There's the rise of the AIIB, the BRICS Bank, and then, of course, the lower price of oil means even countries that aren't jumping on the bandwagon of de-dollarization, they just need fewer dollars to buy oil because the price of oil is lower, so they don't need to boost their U.S. Treasuries. Now, if you have investment demand can counteract the drop in transactional demand for the dollar. And investment demand would mean, well, if the United States pays a higher rate of interest than all the countries that are now paying negative interest rates or low interest rates, then the United States Fed can and the Treasury can counteract a decline in the demand for the U.S. Treasuries. So I think that's what's going on, but that's not what they're going to say. That would be admitting a weakness and that the de-dollarization initiatives are actually working because the United States is not part of the Asian Infrastructure Investment Bank. And so the United States is kind of watching, in a sense, these de-dollarization efforts take place, some of them with their own allies, with Japan and Western Europe. So raising interest rates, I think, is a defensive gesture that they'll make. And we've seen the U.S., other than the non-farm payroll number, all the economic data is poor. But they love the non-farm payroll because they'll use that to say that because all these jobs have been created, we will then see an acceleration in wages, which will then translate into an acceleration in spending, and therefore they can project in the second and third and fourth quarters that the economy will, quote, continue to do well and actually do better. That's why they'll move quickly, maybe even in June or September, because if they wait to raise rates past that, it'll become apparent to everyone two things. One, that the economy hasn't accelerated, and two, that the Fed has no credibility because they've been crying they're going to raise rates for the last year now if they wait until next year. So they need to raise rates under the still surviving cover story that the economy is doing well. And you can see how the media helps them out. U.S. industrial production came down in May significantly. It was negative. It was negative the month before. It was negative the month before that. They revised last month down even more. And Reuters' first sentence is, U.S. industrial production unexpectedly fell in May, likely as a strong dollar and energy spending cuts continue to weigh on manufacturing and mining output, bucking signs of an acceleration in the broader economy. There are no signs of acceleration in the broader economy. So they continue to insist every time a piece of bad news comes in that it's an anomaly when it's the only thing that's happening in the economy. The only anomaly is that non-farm payroll number that seems to come in all the time stronger. And we know why that comes in stronger. It's part-time jobs going to older workers, not to prime-age workers, and they invent the jobs because they invent the creation of businesses with no evidence that the business have been created and that jobs have flown for them. So we're going to see a rate hike, and the reason we're going to see it is, I think, because they want to defend the dollar. They want to defend the treasuries as being a preeminent liquid market and something that they need to make sure foreigners continue to buy, because our deficit in the United States is not going to shrink. We're still going to need to borrow money. In fact, the next president's going to probably want to spend even more money. So we're going to have to rely on foreigners to buy our U.S. Treasuries. Now, yesterday, the Treasury Department released the major foreign holders of Treasury securities, and we follow this monthly. And China has been a consistent purchaser of, at least in their official account, of U.S. Treasuries. They hold over $1.2 trillion worth of treasuries, and they're in the number one position. Japan dropped off about $9 billion treasuries, and that's understandable because they need to spend every last yen they have on buying their own bonds, so they're probably starting to lighten up on their U.S. Treasuries. The big surprise, though, was Belgium, which had at one point increased their Treasury holdings last year up to $366 billion, up from about $180 billion just the year prior. They're down now to $228 billion. So they have really, Belgium, whatever entity that is, part of it's got to be the Belgian country, but then the other part of it is, because it's an international euro clearing area, is from other countries or entities that purchase through that entity. Now, that's taken a big drop-off since the beginning of the year when Belgium had 354 billion treasuries, now down to 228. So whoever that is, whether it's China, a combination of other countries, there's still a significant decline in the Belgian holdings, which had risen at the end of QE. So it kind of coincided with the Fed was buying $45 billion worth of treasuries up until October of last year. And as soon as they stopped, Belgium popped up about $85 billion that 1 month, and then the next month, and they grew from about $180 billion up to about $366 billion. And now they've cut back. So that's a very interesting development there. And you also have Russia, which about a year and a half, 2 years ago, had $166 billion worth of U.S. Treasuries. They're down to $66 billion. So it looks like Russia is intent on driving down their U.S. Treasuries to the bare minimum that they need, probably around $30 billion, and they've been boosting their gold holdings. They'll release their gold holdings later today, and they're almost on parity in dollar terms with their U.S. Treasuries. And Russia also announced that they're going to boost their foreign reserves from $357 billion to about $500 billion, which means even if they increase their gold reserves in proportion, they're going to have a significant amount of gold, over 2,000 tons, when they get to $500 billion worth in foreign reserves. And I doubt that as they increase their foreign reserves up to $500 billion, that they will increase their U.S. Treasury holdings either as a percentage or in actual amounts. They'll probably continue to shed the U.S. Treasuries. So what you're seeing is from allies like Japan, enemies like Russia, and supposed friendly or neutral areas like Belgium, we're seeing a decline in the demand for U.S. Treasuries. Now, normally the Treasuries for the last decade or so, they just increase as more and more countries increase their holdings. There has been some of the foreign countries still hold on to the U.S. Treasuries. They up them a bit. But there's now been, for the first time, cracks in that where some of the countries are cutting back on their U.S. Treasuries. And that, I think, would be problematic for the United States, since more than half of the spending we do is done based on selling treasuries to foreign entities. A lot of it was based in the last 6 years on spending done based on the Fed buying U.S. treasuries. Well, the Fed wants out of that game. They say they want to get out of that game. They've got a $4.3 trillion balance sheet, of which over $2.5 trillion are U.S. treasuries. They really can't keep buying them unless they want to become Japan. Also, if the United States continues to buy them, that sends a signal that the dollar is weak, and that also sends a signal to the foreign purchasers, why should we buy them when you're diluting our holdings by printing money to buy them? Now, the Fed has gotten away with it so far, 6 years worth of QE, Ryan, and the dollar is stronger now than it was in 2009, but they realize that that can't last. And the reason the dollar is going up now is because of this whole prudence and credibility that the Fed is gaining, because they're going to raise rates, they're putting hopes up, and the reason they're going to raise rate is not just because they're a prudent central bank, they're not this reckless, mindless money-printing entity, but that the U.S. economy, unlike the rest of the world, is strong, even though the data indicates otherwise. Well, before that becomes too evident that the United States economy is no better than any other, they need to raise rates, even if that means it crashes the stock market, which I don't think it will do, because as you mentioned at the top of the hour, Ryan, companies and entities have already, with the derivatives, have reestablished positions, let positions lapse in anticipation of this rate hike. And as you mentioned at the top of the show, rates have already risen naturally by the market, so the Fed would only be playing catch-up by raising rates a quarter of a point. That's what I think is going to happen. They probably won't do it in June because it'll be a shock, because they've kind of indicated it's not going to happen in June. But I think Wednesday, they won't play the equivocation game. They will give very strong signals that absent something happening, they will raise rates in September. Before, what they've been saying is that it's data dependent and we don't know, and maybe it'll happen, maybe it won't. Now I think they're going to give strong signals that it will happen in September absent data indicating otherwise. And that's going to be the trick, because the data will indicate otherwise. But what they'll do is they'll explain it away and they'll focus on the employment numbers being strong, and it's the committee's anticipation that the economy is going to do well as these strong labor numbers work their way through the economy.
Yeah, well, it's interesting to me, too. I'm curious to see if the Fed mentions real estate at all in their statement, because as you and I had talked about over the last month or so, it's all of a sudden that real estate has emerged as a cover story again, where it hadn't been for some time. And they've been pushing that, home values are up, there's been appreciation, mainly in your metropolitan areas across the country. Obviously, that makes sense, right, with a low interest rate environment. Many of the rich people that live are the wealthy, the people with more money likely to have stable jobs in major metropolitan areas. The home values are going up. Doesn't necessarily hold true in every single city across the country, but obviously you can skew numbers how you see fit. Most of what's taking place is that the Fed is able to interpret the data, or they claim that they're, making decisions that's, data dependent. So when they have the media that's helping them out all over the place, they can start to throw out, oh, look, real estate's turning the corner again. Look, Homebuilder sentiment's up. They feel good about the market. We've got everything where we want it. And it's like they're basically, just setting the ball on the tee, right? Just setting it up. All they got to do is just pull the trigger. Now, you had said that you believe that they will raise. I keep saying that, they got to prove me otherwise, because I'm just in that camp now where I just don't trust anything they do or say. So I'll just wait until they do it. At this point, yeah, it wouldn't shock me based upon all of the information that's been put out there in the media, that this is, especially with this Treasury release here of the holdings, and we can see that there's been a significant taper from a lot of the people that were purchasing quite a bit, namely Belgium. So if we don't make that credibility play, then I would expect for these holdings to continue to decline, and they don't want that. So what's the way to pick it back up? Make the move, raise the interest rates, and then everybody's like, well, looks like they've got their act together. Now, the bigger question is, Lewis, will the rest of the country be fooled by this, or will they, buy into it and continue to purchase more treasuries?
When you mean the rest of the country?
Meaning the rest of the world. Will the rest of the world see that if we raise rates, will they see that as, okay, maybe the U.S. does have their stuff together and will continue to buy treasuries, or do they see it as, hey, they're just trying to trick us once again, and we're going to continue? No,
I think it all depends on when they raise rates, what the Fed says. If the Fed starts acting like they might continue to raise them, then they won't be tricked. They'll feel like, yes, the United States is serious, it's going to normalize rates, and, buying treasuries now cheaper and getting a higher yield is a smart thing because rates are set to go higher.
So is that your anticipation that that's what's going to take place, is that they're going to raise them, that make the token raise now, and then start to say continuation of rate hikes, but they will not give a definitive timeline and drag it on for years?
But they'll make it sound like they are dead set on raising them and reducing their balance sheet, but to be patient while they do that. But basically that the inertia is not one and done, but that they're going to continue to push rates higher, and that'll attract the demand.
Yeah, it's
they won't do it. They won't go to 3 or 4 or 5%. That's not going to happen.
Well, no, they do not.
All they need to do is be on a relative basis higher than the other countries. Swiss National Bank, Bank of England, Bank of Japan, ECB rates, they need to be higher than those. And they will be.
Well, I think that you're right because, I mean, it's not like a big move. It's enough to show that they're serious about changing
they're not.
policy.
They're not serious.
Well, you know what I mean, though. They just to appear as if they're serious.
Exactly.
And that's all that really matters because the Wall Street, hedge funds, the rest of the world doesn't have anything to do but listen to what they say. The stock market is completely an indicator of that. They've been following in lockstep with the Fed for 6 years now. And I don't expect for that to change. They've already kind of baked it in. So if everybody's expecting for the stock market just all of a sudden crash when this hike happens, I think you got it wrong. Because all that will happen is that they might pull back just a touch. If things start to get worse again, as you mentioned, they always have the silver bullet, right? The silver bullet is that they just say, well, unexpected turn for the worse. And they unleash it again, and it's just basically back. They don't have to touch the rate at that point. They'll just print more money. Call it something else. They'll call it, it doesn't have to be QE. They'll come up with something creative that doesn't have anything to do with that. And then we'll be right back to where we were. And this is the danger of all this is that we're just going to continue doing this on and on and on for years and years and years because there is no way to come out of it short of just letting everything collapse and build it back.
See, people interpret what I'm saying sometimes is that I think that the Fed is going to raise rates 3% and 4% and so on, and that they've finished money printing. I don't believe that. I believe they're doing it so that they can print more money because they have to. But what they can't do is come out and say, like I mentioned on the last show, and they said in 2009, we're just going to print money for the next year, and it's going to be $4.3 trillion. The dollar would have collapsed. Instead, they space it out. They say they're going to do it. They're not going to do it. They're going to raise rates. They're going to taper. They have to give the impression that they're not just on a one-way, that the printing machine isn't just, they don't just push print and set and forget. They have to make it seem like there's not just pauses, but they're going to stop. So that's why they have to raise rates, because all they've done so far the last 6 years is stop. They've never raised rates, So people are starting to think QE1, then QE2, then QE3. So logically, they're going to do QE4. That's fool me once, shame me. It's 3 times now. 3 strikes are out. You can't just go from QE3 to QE4.
Mm-mm. Well,
they have to do something. That, like you say, there has to be an interval where they say, "Oh, wait a minute, we were raising rates, but look what happened. Now we got to do." And they won't call it QE4; they call it something else.
Yeah, and the media will get behind them and help push it.
It's necessary because it worked. You know what they're going to say, Ryan? That in 2014 and 15 we had this massive recovery because of QE.
Of course, it didn't work for 4+ years, but then all of a sudden it just started working, and now more people were able to buy houses, and wages were rising, and jobs were plentiful, and the home builders got excited, right? Because you can see the storyline, and that's why you always know moving into. Remember when they made the mistake of when they tapered and they scared the market? Do you remember what happened when they did that? They didn't signal when they were going to do it. And they started yapping off in the media, and all of a sudden, everything went crazy. Now, they won't make that mistake again. They realize that they screwed that up. Now they're trying to specifically signal when they're going to do certain things. And, it may not happen at the exact meeting that everybody thinks it'll happen. It may happen earlier. It may happen just a touch later. But I think that now they know that when they say things, that it's important that they follow through because their credibility is going to go out the window. It's already gone out the window for you and I.
Absolutely.
We talk about this, but literally, it's a joke. It's a complete joke what they're doing, and the reason why we talk about it is because we have to basically take the information that we have and give our take on it. If you listen to CNBC, MSNBC, any of those shows, they'll tell you that the Fed's got this under control. It looks like the stock market is poised to move higher. Of course it is.
But, Ryan, what people don't understand, people who listen to us and other alternative media, they think that the rest of the world thinks the way we do, that it's a joke and the Fed has no credibility. The Fed does have massive credibility. Mm-hmm. It's only to a small number of people who are paying hyper-close attention that think that they have no credibility. For most people that are in the market, they just go by what the Fed says. People that are out of the market don't even know what the Fed is. So this concept that, it's almost like you're in the echo chamber with these people. They think that everybody thinks that the Fed is a joke and the Fed doesn't know what they're doing. That's not true.
Yeah. Well,
the Fed has massive respect around the world.
Well, and you know what? If you're the big
they may not
bank,
like the
hedge
Fed.
Funds, well, yeah, I just figure if all the rich are talking about how the Fed has it under control, there's only a few out there that are saying if stuff's going to crash and they're playing Armageddon because they're positioning themselves to look like a genius at some point, maybe in the distant 10-year future. But the reality is that most of the big banks, they could care less. They will just follow exactly what the Fed says and does because even if stuff does hit the fan, they're going to get bailed out again.
Oh.
So it doesn't matter to them.
Or they've already adjusted all of their trading positions on the basis of knowing what the Fed is going to do. So if they know that the Fed is going to raise rates in September, they've already adjusted their positions to make money on that move. Because they know what's going to happen. They're not betting. They know it's going to happen. They've rearranged all of their financials and all of their derivatives to make money on what the Fed does. Now, whether you call that respect or not, it's market respect. Because they pay attention, because the Fed controls what happens. And when someone controls what happens, you may not like them, but you must respect them because they have the power to effectuate a result that impacts you. You can complain about it. You may think they're morons, but they do have control of the game.
Oh, they do. They are the Wizard of Oz here.
More so. Because the Wizard of Oz is only playing with a little girl's brain in her head on whether it was someone was going to get a heart or a brain. This is the entire world economy. Well,
and what's been amazing is that, you and I didn't think that they could get away with it for as long as they have. And they've been pretty masterful at being able to control and manipulate and brainwash and anything else that you would like to come up with. But, since our economy is a Fed-based economy, I don't care what anybody says.
Absolutely.
It's completely Fed-driven, meaning it's completely manipulated. It's completely artificial. There is no foundation. There's no underlying fundamentals. I don't care what Squawk Box says. I don't care what any of those shows say. There isn't. All of these companies are not creating any true value in the world. Actually, I take that back. There's a few that are actually producing something and actually making money from it. But this entire economy, the startup bubble is next. That's what's going to get crushed because all these companies, as we mentioned, Zillow and any of the new startups that you can think of, are not producing any real money. They're not making money. But yet their stock prices push higher, so they're, everybody continues to buy more and more, pumping it higher and higher. And there's this sense that they have to be a strong company. I think Overstock.com last quarter, I don't know what it was, they lost hundreds of millions of dollars. It's unreal how a lot of these companies can continue doing that. But yet the small guy, the small business owner that's trying to get his restaurant or his automotive place up and running can't get capital from the bank because good luck getting a loan. Banks don't want to give loans right now with this low interest rate environment. They'd rather take that money and gamble it in the markets because they can control, or they feel like they have more control because they're following exactly what the Fed's telling them. Right? Versus they're going to take a risk on another human being in a business? Nah, I'd rather just do whatever the Fed tells me to do.
And make a 5% return? So what's the point?
There is no point because they know that, the Fed, they don't want to screw this up. So they're so scared that the banks won't take risks that you're lucky if you can get a mortgage. But when you start talking about business loans or anything else, good luck. Because guess what? Most people don't have stable job history. They don't have wage growth. They don't have their revenues. their revenues probably are barely rising. Their costs are going higher. They're not going down. I mean, on a daily basis, I'm having conversations with people, and even other real estate agents, even in the Northern Virginia area, that are telling me, what are you seeing? And I've already talked about this. I've told you that all the appraisals that I've seen have been coming in lower. Don't think that wasn't some sort of regulation that was put into place to now that they can double-check appraisers and suppress values, because you can claim then that they won't let values get out of sight. They'll kind of stay in this area where it's like maybe 1% to 2% growth, not too much, because in the major metropolitan areas, they've gone out of sight. They can start to cap those back a little bit by having appraisal problems. We have, still decent low down payment options out there, but yet they're not being jumped at the pace that you would believe if everything was moving in the right direction. See, I honestly feel like this is the first place we should really look. What are the hard numbers for the amount of applying for mortgages, for purchases, not for refis, but for purchases? How many people is it that's doing that? Because if it was such a strong economy, these numbers would take care of themselves because people would feel so good about themselves. Right. They want to put their family into a nicer house, a bigger house maybe, right? They sell their existing home and move to a different one. But these numbers don't lie, Lewis. They're not showing that at all. As a matter of fact, when I drove up the street the other day, I see builders discounting homes significantly, very close to resale prices. So the home builders.
Well, one of the home builders announced in its earnings report that their earnings were hit because of the massive amount of incentives they had to offer to make the sales that they made that quarter. I think it was Hoverian. What's the one?
Kay Hovnanian. Yeah, Kay Hovnanian.
Yeah.
Yep. Well, it's interesting because, so home builder sentiment 59 versus 56, so it's stronger than expectations. So is your sentiment strong because your sales were up because you were incentivizing? It's not because your profit was so much more. It's because you were giving the houses away at that point.
Well, it's the same with the auto industry, right? Yeah. Auto sales are at all-time highs, as are prices, but that's because the average FICO score is 552. 13% of people buying cars with auto loans don't even have a FICO score. So what do you expect? I mean, you can raise rates. I mean, you can raise rates. You can boost sales if you're basically giving it away.
Well, it's so frustrating to me, Lewis, because it's like, I'm in this real estate business on a daily basis. And one of the things that I pride myself in is that I'm not the guy that's out there saying, buy real estate, buy real estate, buy real estate. Now, when we look at somebody's individual situation and they've got money saved up in the bank, great credit, whatever it is, and they have the capacity and ability to take advantage of low interest rates, yes, great time to buy, right, for you, because you have the means. But for somebody that has $100 savings in their bank account and credit score is struggling, debt-ridden student loans, auto loans, barely scratching, to make ends meet every month, I don't necessarily think buying a house is a smart thing. Now, there is a caveat to all that. If you can find free government money and get a grant and get into a home that's going to give you a cheaper payment than your rent would be, and you're not coming out a dime out of pocket, you can somehow qualify for that loan, then by all means do so. Because that means that you just, you got a lower housing expense than you were currently paying. But the reality is that most people can't get that loan.
But they can get a car loan.
You can't, yeah, because they'll give a car loan.
And as you mentioned, you can get credit card. The one thing you can't get is the mortgage. And one of the reasons you can't get the mortgage is because you already have the credit card loan, the car loan, the student loan.
Right. So now your debt to income ratios are high. So now it's gonna limit the ability on what you could afford. So and that's the other thing. So let's just say that you could get qualified for one of those first time homebuyer programs, but you have all this debt. Well, in a major metropolitan area, you're probably not going to find something but for like $400,000+. So with all that other debt, you're probably only going to qualify for $200,000 with all the other debt. And at that point, you're going to say to yourself, well, it looks like I can't buy, or I'm going to have to move south. So, I mean, I'd love to think that this economy had turned a corner, but see, I can see the numbers, and the numbers tell me that.
Why would the economy turn the corner? It would turn it on consumer spending, right?
Mm-hmm.
Well, where's the consumer going to get the money? Their wages aren't growing. So that's what the Fed is going to say, that the job growth will lead to wage growth, which will lead to spending growth. Won't happen.
How long
the consumer is tapped out. The consumer has too much debt and not enough income.
And how long have they been saying that the consumers have been holding back and they're going to spend next
quarter? They're not holding
back.
They can't spend what they don't have.
Right, because what they're spending is they're spending on credit cards. They're not spending their own cash. They're tapping the credit that's given to them.
Buying autos and credit cards. Auto loans are $1 trillion. Auto loans are actually at a higher number than credit card debt.
Which is wild.
They're both about $1 trillion. Student loans are over that.
And it's not, all of a sudden you've got your auto loan, you've got your student loan, you've got
credit cards,
health insurance, utilities, food bills, all
food's going up.
Things.
Gas has gone back up. There's no more gas benefit for low prices because they're almost back to normal.
Yeah,
back to where they were.
Come on, Bush. Though the Fed's not going to recognize that we actually have rising food and energy prices. No,
they want higher. What they're using that as an excuse. They use that as an excuse not to raise rates because they didn't see enough inflation.
Well,
economy needs lower prices so that people can afford stuff. Maybe then they would spend.
Well, I often, I say this all the time, but it's a higher interest rate environment is more conducive actually for home sales, in my opinion, in my estimation, because what happens is that investors are willing to take on more risk to give loans. And a very low interest rate environment, 4% or lower, I can tell you, they're going to scrutinize and find a reason to try to deny that loan. Now, they can claim FHA, they can all claim that they don't do that. They can claim whatever they want. The reality is the numbers. And
who wants to loan money at 30% at 30 years at 3%?
They don't. And most of these programs that are created are it's politically driven. We want to say that they're out there. We can claim another 4-letter acronym, HARP, HAMP, HAFA. Who knows what the next one will be? But you don't have to do those things, Lewis, if we have a strong economy. We don't have to do those things. But the fact that we do, and then the fact that we're continuously regulating, over-regulating, then deregulating, back and forth, we're playing this ugly game, and nobody knows where to get money from, so they just regulate some more, and then that's how the government continues to pull money back in. It's a very, very bad environment for business, except for the uber rich, except for them. I believe it was somebody slipped up, and one of the Fed officials basically said that they know that keeping this interest rate policy like it has for the last 6 years has created a great disparity in wealth, really. But that wasn't the intention. That's just kind of what happened. It was a byproduct of the policy.
It's a byproduct of the policy. Yeah, well, Yellen, when she joined the Fed, was defensive. Not joined the Fed. When she became chairman, she gave an interview. Either Time, I think it was Time magazine, not Newsweek, and she was already on the defensive, saying that that people think that QE is just for the rich, but it's not. It creates a wealth effect. Everybody who has a home. Bernanke said the same thing. A lot of people have homes. Their value has gone up, so they've benefited. When their home prices go up, they feel richer, so they spend more money. The stock price goes up. So basically, they said QE was designed to create a housing bubble and a stock market bubble in absence of real growth. And then the way the growth would get driven is people would feel richer, they go out and spend money, and then somehow things would get produced in China because people had money to spend. Didn't work out that way.
Sure did.
It rose the asset prices, and what they're failing to understand is you have to be relatively rich to be in the stock market and relatively well off to own a home. And for many of the people who own a home, they don't really own the home. They owe mortgage money on it. And a lot of those people, all this did was put the home price back to near where they bought it from. It doesn't make them richer. Doesn't make them want to go out and spend money. Just relieves them that maybe they won't get foreclosed on.
Mm-hmm. Yeah. And, a lot of the clients that I've had lately have been fortunate enough that they have some equity built up in their house that they can actually sell their home they have enough money from the sale of that home to turn around and then go buy their move-up home or just a place that they plan on staying for the next 10 to 15 to 20 years. Now, the interesting thing is I've been listening to a lot of what these type of buyers have been saying, and we know that the average buyer moves every 5 to 7 years. I believe those numbers have kind of changed because the percentage of people that have been underwater buying back in, 04, 05 in that time frame, they're still 10 years later stuck in those properties if they haven't already been foreclosed on or went through with a short sale, right? Mm-hmm. So right then, that 5 to 7 year number kind of gets thrown out unless people strategically defaulted, allow that house to go back to the bank, and now they're 3 years later ready to buy again. But what's interesting is that the majority, to me, of the buyers that are entering the market are either first-time home buyers, not young first-time home buyers, but older first-time home buyers, like somewhere between like 26 and 30-something years old that have been renting for some time, or the move-up buyers being the ones that do have the equity from their current property. They were able to hold on and continue to make payments, and they've got enough equity, they can pay real estate fees, and they have enough for a down payment on the other side. I wouldn't say that that's the majority because I still feel like it's about 25% are still underwater. It's still the 1 in 4 rule. I don't really think that that's going anywhere. Right. Because we had such a huge jump in equity during that period of time. Literally, it could take 30 years to get back there.
Well, because the reality of it was those prices that we're trying to get back to as, quote, normal, they weren't normal. They were too high, and they don't justify, even at today's salaries, those high prices. They were only affordable then because of the giveaways and the liar loans. That's what drove the prices up. In a normal market, they never would have been that high. So that's not a normal price to get back to.
No, they were never. The intent of many people that bought those homes at those high prices was that, hey, don't worry about it. In 2 or 3 years, you'll have enough equity. You can refinance, pull some cash out, take out a new loan, and then continue to float yourself in that house, right? Or take out a negative amortization loan, because then you don't even have to pay the interest payment. You just pay the minimum payment, which is like $1,500 less than the interest-only payment. Don't worry. You'll have equity in your home because it'll build over the years, and then it doesn't, and then you're stuck.
Yeah, so, it's not like a stock. You can actually get away with, like Apple, it goes higher and higher. There's no price too high for a stock, but we've mentioned many times a home price is restricted by gravity and by the ability of people to pay and service a mortgage and pay the taxes. A house cannot go in a residential middle-class area, can't go to $5 million. Just can't.
No, it can't.
Can't go to $2 million. The people can't afford it. A stock is never unaffordable. That's why it's easier to boost the stock market than it is the housing market.
And you know what? Because to be able to really get home prices to rise even to a much higher number, you'd have to have wage growth. You'd have to. Or you'd have to go back to the liar loans again, because there's only 2 ways you can get there.
Look at car prices, Ryan. You can get a car. They sell trucks $50,000, $60,000, $70,000 now because they're giving away loans. People can afford it.
Yeah, and you know what they keep doing? They keep raising the term of those loans.
Yeah, if you want to pay a loan over 80 months, 6, 7, 8 years, yeah, sure.
Yeah.
Then you can afford an $80,000 four-door, which should only cost $20,000, but instead they're charging you $70,000, $80,000 for it.
And the minute that you drive it off the lot, it's worth $50,000.
Exactly. And that's supposedly driving the United States growth. People driving cars assembled elsewhere.
And until the gas prices go back up, and then they have to get rid of that truck because now that their gas payments are more than the actual truck payment.
Not a problem. Make a government program. Oh, cash is funky, right? Just turn in your car, we'll take it, and we'll send the scrap to China.
Yeah, I mean, it's as we move towards the next election, for whoever does get elected, probably Hillary, even though she's got so much crap behind her right now.
Unbelievable. She should be disqualified out the if it was any candidate, right? And you said, here's her background.
Yeah, like she shouldn't even be allowed to step up there, right? But it's unbelievable the amount of baggage that she has with her right now. But she'll still end up being in there somehow. Everybody will forget, and then she'll promise.
It's not like let's say it was Dwight Eisenhower, and he had all this baggage, but he had won the war. But he had won the war. You could overlook that. You say, well, yeah, but, he did D-Day. He saved the country. Well, she didn't do anything.
No, but she was broke.
She just had baggage.
Don't you remember? Well, no, she was broke. She came back from being broke. She was over-leveraged. And
she's a success story.
Right.
Giving speeches and taking broths.
Yeah. Mm-hmm.
Well, you know what it is. The people don't. The average voter, they call them a low-information voter. They don't know any of this. They just know she's a woman, and her husband used to be president, and so why wouldn't you vote for her?
Yeah, and don't you remember when Bill Clinton was in office? Times were good. He did a great job. Everything.
Yeah.
And if you vote Hillary in, the same thing will happen.
That's logic. You don't have to consider different times, different. It's just that's what will happen.
Well, don't be surprised if Bill's not out there touting. But they say he's in bad health. Somebody said that Bill himself is not in very good health, and it'll be interesting to see if he's going to be able to push her. She doesn't look very good either. No.
In today's world, when Reagan ran in the 80s, or 70s and 80s, if you were 65, it was like you should be playing shuffleboard, and that's about it, if you can get out of your wheelchair. But now, no, seriously, but now 65, 7 years old is not a disqualification for running for president. I think McCain, in the last 10, 15 years, when a candidate runs at that age, no one mentions anything.
Mm-mm.
In fact, even Ron Paul ran. He was probably 75, 78 years old, and the issues with him weren't he was too old. The issue with him was they didn't want to hear what he had to say.
Oh, I was going to say, he made too much sense. Anybody that can talk intelligently on the economy and the foundations of the overall economy, and they don't want you in there.
No.
They do not want you in there. You cannot make business sense, because this country is not run like a business at all, because it's a failed business, right? And without the Fed, we are nothing. There's nothing there.
Oh, if we didn't have the ability to be the reserve currency and to have the Federal Reserve backstop that reserve currency with the military, the industrial production here we're living off of fumes. We're living off of trade agreements. We're living off of, not off our own production.
Mm-mm.
We're living off of, if you think about it, San Francisco and the Bay Area and Silicon Valley, they're living off of pie in the sky. Massive amounts of wealth are being created out of no profits. Now, if you can run that game, we have a monopoly on that. Because why doesn't any country just start up an area and say, okay, we're just going to have a bunch of young people come up with ideas, and they're going to get funded, and we're going to slap billion-dollar valuations on them?
Right. One in 100 company will be a billion-dollar company. Will make it rich, and then we'll do it again, all over again. With
what's interesting, Ryan, we mentioned this last week, but even the 1 in 100 companies that quote makes it, they don't even make it. Because those companies are called Zillow, Amazon. They're companies Uber, that don't make any money anyway. They just happen to, quote, make it in terms of getting public and making even more money for the investor. But they're not making it in the sense that they're driving profits.
No, they make it in terms of that they hit the metrics that they want to hit. That Wall Street tells them is what's important, which is user count, website hits, views, things that don't matter.
Well, they matter if you can translate them if you can monetize them. But if for 10 years you've proven you can't monetize it, the next 10 years shouldn't be any better.
Well,
because you've already passed your growth stage, and you're not going to grow much more.
No, all you're going to do is buy out another company and then take their revenue and say that your revenues are now going higher.
Yeah, your profits are going lower.
Yep. Well, that's just where we're at this point, right? The startup is the next big bust. It will happen because that's where people are taking all their stock profits, and dumping them in. Everyone wants to turn into a venture capitalist at this point. where everybody's investing in somebody's idea, hedge fund. So the next bust will be at that level where they're going to turn on its head and it's going to be like, you know what, this went on for way too long. Now, as long as the Fed's there, it can continue on for some time. But when it does...
but the warning to San Francisco, when you have the median home price at $1.3 million and you have people paying for them because they work at companies that don't make any money and they actually believe it's sustainable, that city is going to have the biggest bust it ever had.
Yep.
I mean, there's no way they can sustain those home prices. There's no way that those companies can continue to be minted and brought to market with private capital, venture capital, and expect them to continue to have the valuations that they have. Because once those valuations go down, even if you're making whatever they're making in salary isn't paying the rent. It's the stock options and so on. And they won't even have the job anymore because those companies will go out of business, and the ones that are barely making it are going to fire employees because they won't be able to raise more money to hire more employees.
Well, you know what's interesting to me is that like all these venture capitalist hedge funds, when they're going into these startups and, you know, they want a return of 5x, 10x, 50x, 100x, 150x.
So do I.
But they realistically, these companies, the only thing they really want from them is to go public, and then they can basically, you know, make tons of money from them going public and their shares rising, right? But yet you have, and you're basically 1 in 100, 1 in 1,000 that does that, or whatever it is. So yes, you have real businesses that actually make real money, not the fake money, but the real money.
Mm-hmm.
But these venture capitalists won't invest in those businesses because they don't have a 10x, 100x capability.
They're only interested in a scam, something where they can actually create. What you see it in their earnings releases. They put at the bottom of the press release their actual earnings. At the top of the press release, they explain why earnings before interest, amortization, and everything else, why they're actually profitable. And they'll explain why they think that their metric that they created, not the standard accounting metric, is the one they should listen to in valuing the company. And at the bottom, they show, and we lost $8 million this quarter. We lost $90 million. But if you didn't count all of our expenses, then we would have made money. And we think this is how you should look at it.
Yeah, don't worry. Over time, those expenses will go down. And
I want to be able to write my own test and grade my own report card, and get it accepted as like. I want to go on an interview and say, I went to this school, it's the best school in the country, and I got an A in every course. And they're going to say, what school is that? So it's my own school. And I want you to accept it. The difference is I can't go to an employer with those credentials. These companies actually manage to go to the market and say, never mind standard accounting, never mind GAAP, accept this. And there are people in San Francisco and in Silicon Valley working for these types of companies thinking that those companies are actually making it, doing well, and they're going to be quite a surprise when the stock market crashes, the real estate market crashes, and they're going to be saying, but we were doing so well. Yeah, based on the fake metrics you made up that you managed to get other people to believe.
Yeah, it's going to be an eye-opener for many people. I mean, all good things.
And the same for the people who invested in housing there. Oh, San Francisco housing there'll always be demand. Well, not at $1.3 million there might not be.
No. Affordability is not there, and when some of those companies start to shut down, everybody will be scrambling. And then the prices will tank, and then we all know what will happen from there.
Well, the question here is, San Francisco has gone through some boom busts before, and it's always come back, and maybe it'll come back again. But in the overall sense, we've now seen this is the third bubble that's created. The internet bubble, the housing bubble. This one's even bigger than both of them combined. And this one and the other two were driven by the Fed's ability to manipulate interest rates and to put money at it. Is there enough juice left to pick the pieces up after this one? This one collapses.
I don't know. I don't think there is. I don't think there is either. But
that's why they're scrambling probably to raise rates right now.
Yeah. Only time will tell, though, I guess. Right. We'll have to see what they can concoct. But we're up on here at the end of the show, Louis. I wanted to thank you again for coming on. Obviously, we'll follow the Fed's policy statement, and I'm sure it will give us enough material for next week's episode. In the meantime, if you wouldn't mind, give our listeners your blog so they can check that out and catch up to date with any of the blog posts that you put out over the last week or so.
Sure, it's smallgold.com. This week we have the silver and gold ETF holdings. The gold ETF has shown a decline of about half in the last year and a half, and the silver ETFs have kept their holdings constant. And then we also have the, as we mentioned at the top of the show, the top foreign holdings of U.S. Treasury. So please check that out at smallgold.com, SMAULGLD.com. Thanks.
Thanks, Louis. Appreciate it. Thank you guys for tuning in. We'll be back again next week. In the meantime, if you have any questions, go to realestate360live.com. Ask a question button on the right-hand side. Also, to download, subscribe, share on iTunes. Search in the bar at Real Estate 360. Until next time, guys. Take care.